And good morning and welcome to Navigate B2B. I am your host, Steve Ferreira. I'm CEO of Ocean Audit, a global ocean freight recovery audit firm. Well, Navigate B2B is a new type of programming here on FreightWaves, and we're so glad that you're joining us. What is Navigate B2B? Well, it's really a lifestyle movement. It's a movement towards the B2B persona within you. On our channel, in our content, we'll have all things business, finance, sales, social media, promotion, as well as a healthy dose of ocean freight. After all, this is my 38th year in the industry, an industry I've known and come to love so well. And I think that by promoting the content of the B2B persona and the lifestyle within that in ocean freight gives everyone a really dynamic viewpoint on the issues impacting your business, your sales, your marketing, your personal finance, and your business life. So sit back and enjoy the gentle, dulce tones of my voice today as we cover the obscure world of container shipping stocks with my special guest, Jay Minsmaya. Jay, welcome to the show.
Hey, thanks, Steve. I really appreciate it. It's great to be here.
Well, it's an honor to have you here, and I'd like to introduce you a little bit to my audience. And I will tell you that, Jay, you are the talk of the town in the Ferreira household. Jay is not only the lead researcher with Value Investors Edge, one of the leading shipping researching industry stocks in the world, and Jay's market is high wealth net individuals, hedge funds, equity, all types of research that Jay has branched out on in his really unique niche in the world of shipping, not only container shipping, but general purpose shipping. And Jay, I want to thank you for your service. Jay is an Air Force Academy graduate, Air Force officer, and he comes to us live from Boston, Massachusetts, where he's doing his PhD studies in public policy analysis at Harvard. Wow, Jay, we are in love with you in the Ferreira household. Welcome to the show.
That's very generous, Steve. I had to put away my graduate microeconomics textbook before I got on the show today, so I'll make sure we'll talk freight derivatives, but we won't talk economic derivatives.
Well, Jay, I'll tell you what, you are everything that Navigate B2B. You are the persona itself of Navigate B2B, and we're just so pleased to have you on. Because to be quite honest with you, in my 38 years in the industry, some of the things that you have opened my eyes to and are so impressive and so dynamic and so important. I believe that my peers in the industry and our viewership live right now as we project out to the world, these are all new topics that many of us don't have the capacity to yet understand, and you're bringing us that new knowledge of what the B2B lifestyle is. And so I named this topic "The Tale of Two Cities." And when you really look at this, is when Dickens wrote that, I mean, we're really talking about the possibility here of resurrection and transformation in a really obscure industry, container shipping. And I know that your specialty is all shipping, but today we'll focus on the container players. And so this little crazy backstory that we want to talk about today in terms of the industry, in terms of how the industry, I mean, I know we talk about the main players. We've got CMA, we've got Maersk, we've got Hyundai. And, we know that they build their ships and they own their ships. And we have a very interesting graphic that we'd like to promote in terms of talking about why these obscure container stocks that we're going to get involved in are so important. And when you talk about the images in the container sector, it is an oligopoly. Could you explain to the audience just why container ships in general are in the state that they're in, both from the perspective of really there's nothing being built out there, and how does that reflect on the dynamics of the shipping market in general?
Yeah, absolutely, Steve. And I love the transition with Dickens and the Tale of Two Cities because, that really is the difference we've seen in the market this year. We nobody wants to go out and buy shipping stocks in the midst of a global pandemic, right? Common sense would tell you that that's a terrible idea. However, that's not the way that's shaken out. And there's a few reasons why. So one of the key reasons is that the container ship market is very tightly controlled. It's basically an oligopoly. And I think there's a graphic I sent you earlier, but it will show it later. But it basically shows the breakdown of the top 5, top 6 container ship lines. They control a vast proportion of the market. So that's part of it. Another part is that, the prospects for container ship sector have been Moderate for a while, right? We've been in a 10-year bull run. Everyone's been thinking the global economy is going to slow down eventually. So there hasn't been a lot of speculative ordering. The order book, future supply of vessels, is very much under control. So what happened with COVID-19 is you have this global pandemic and there's a sudden crash in demand levels. And we saw that in April and May. But the container lines responded basically immediately. They started rationalizing their supply. They started spreading out their shipments. And then it turns out they did a little bit too much of that, because it turns out that once everybody's stuck at home, they're buying more appliances, they're buying more TVs, they're buying more household goods, the kind of stuff that you think of from Amazon, from Walmart, from Target. And where's all that stuff come? Well, most of it comes from Asia, and most of it comes in these container boxes. So demand for container ships is actually up year over year, which is just fascinating.
I really appreciate that perspective. And how do you see, when you look at the order books, for example, how do you see the fact that there is not much on order? I mean, obviously, when we talk about the participants in the shipping stocks that we're going to talk about today, these container lessors, when there is a lack of new builds, just how much does the switch turn over to them in terms of them having an advantage over the rates they can charge, say, a CMA or a Maersk? How does that impact the market in general, Jay?
Yeah, so the interesting thing about the new builds is they were very clustered in the super large vessels, right? The stuff that can carry 20,000 container boxes or 22,000 container boxes. That made up the majority of the order book. There's also a few small feeder vessels, maybe something that holds 800 or 1,200 boxes, and those do kind of intra-port, intra-regional Asia type trades. There wasn't anything in the order book for really almost a decade in any of the middle-sized vessels. So you're thinking a lot of the stuff in some of the larger ports in Asia, some of the developing ports in Africa and the Middle East. Of course, Middle East was in a big lockdown, also hitting that consumer goods boom. So you look at that order book, and there's nothing there. So if demand goes up, rates can only go upwards, and that's exactly what we see in the markets. In terms of why you would place an order, new build, you would do that if you believe that, of course, your long-term 10-year, 20-year, 30-year returns are going to be higher than just buying a ship on the secondary market. And that's another dislocation we've seen, is that the values of these secondhand vessels have not moved yet. Folks are skeptical. People don't want to go out and buy a ship on the secondhand market. Well, that means the prices are cheap. So if the prices are cheap in secondhand, nobody wants to order new builds. So we're stuck in this weird sort of cycle on the asset side, which is doing nothing but promote these high rates.
It's really interesting. And when you talk about that, what do you see as the characteristics? I mean, in terms of these companies that we're talking about, I think we have a graphic on that. We talk about Global Ship Leasing, Danos, and some of the other players. And we're just seeing the slide there in terms of the new builds. But if we talk about the slide or the images on who the players are in the shipping stocks, the leasing companies that own these vessels, who are the main players?
Yeah, so we do have a slide that shows all the main players, and of course, there we go. There's the perfect slide for that. So that kind of orders them in market cap. So in terms of just the largest companies to the smallest. So Atlas Corp is the largest, and that one used to be called C-SPAN. Used to be traded under stock symbol SSW. I'm sure some of our listeners and viewers are very familiar with that stock. That one's interesting as well because Prem Watsa actually got involved with one of their refinancings, and of course, so they're the largest company. Costa Murray is another one. You can just read the list. I won't go down every single name. For disclosures, though, I want to make sure that folks understand I do research these stocks. I work with funds and such, and I have positions of my own. So I am currently long. You can see at the bottom there, Capital Partners, Global Ship Lease, and Navios Partners, and Navios Containers, just so everybody understands that.
It's really interesting to see the players. I mean, these names are companies based in Greece and Monaco and London, and again, they are a bit obscure, and yet they're controlling. Would you say 90% of the charter markets out there?
Well, there is sort of a differentiation. So the first slide that we showed was the actual shipping logistics companies themselves. So those are like the Muller Maersk, those are the CMA CGMs. Think of those like your UPSs or your FedExes, right? Those are the type of comparison there. Exactly, that slide there. Those are the actual freight logistics companies. The companies that we're investing in are the ones that own the assets themselves, the ships on the water. So think of it this way. Think of like, for a parallel, think of like UPS and FedEx as having a boom of deliveries because of Amazon. But I own the company that owns all of FedEx's and UPS's trucks And guess what? The lease for those trucks is coming up in 3 months. Every 3 months, I get to lease more and more trucks to FedEx and UPS. That's exactly what's happening here. The leases on these vessels cycle through every 3 to 6 months. There's new leases signed, and those lease rates are skyrocketing. So I'm not talking about buying the actual logistics company that's doing this coordination. I'm talking about a hard asset play. It's easy to value, it's easy to understand, and the lease rates are going up astronomically. The stocks had not. And that's what happened 2 months ago, Steve. And I know you were one of the first to kind of catch on to this as well. 2 months ago, UPS, FedEx, Muller Maersk, they're all at 52-week highs. People are understanding the logistics. All these container leasing stocks were like 52-week lows.
Yeah, we talked about Matson and Triton and some of the container box lessors out there, and those are easy. I mean, they were all spiking at 52 weeks high. I mean, Matson had a little bit to run when they had their earnings, but I mean, most of the other players, were almost fully valued, and it's really interesting. But I want to touch base on the issue you just raised a few seconds ago about rates being at an all-time high, because I think that this is really kind of like the V-shaped recovery for the container shipping industry. I know we have a graphic on that where we talk about the charter rates being at an all-time high, and you use a tool, I believe it's called the Harper Index. Could you speak to the audience a little bit about that? Here we go.
Yeah, exactly. It's called the Harpex. It's put out by a freight brokerage called Harper Peterson, and you can just Google this at home. Put in Harpex right there into your browser, and it'll come up. They update it for free every Friday, so it's a great source of information. Shipping is such an asymmetric information area, which we love, and we profit from that because we have access to some of the best data in the industry. But I always like to be able to share freely available data, and this is one of them. And you can see right here the 5-year chart, and you can see the max there. In fact, funny story. 5 or 10 minutes before I came on air, they put out the new iteration of this chart. This is actually outdated by almost 10%. I mean, that's how crazy the rates are just going. So even today, they updated the rates. They're 10% higher yet. This is a 5-year chart. If we zoomed out further, we're actually at a 12-year high for rates.
And one of the things I love about this too, and you mentioned it's you can go to the website the Harper Index site and see this. You can actually see the rates, like how much per day rate each class of ship is getting. Correct, like, and you just see it going up and up, like from 30,000 a day to 32 to 34. Correct.
Exactly. And you can see where the sweet spot is. And the sweet spot are these mid-sized vessels, 4,000 TEU. A TEU, for those at home, is a 20-foot equivalent unit. So basically, like, think about a semi-truck driving down the road, or think about a railroad car, that box you see. That's a TEU. So those mid-sized vessels, they carry 4,000, 5,000, 6,000 of those container boxes are the absolute sweet spot to be in right now.
This is really fantastic, and I want to play off of your expertise on talking about the dynamics between the stocks that we're talking about, the container ship lessor companies versus the general logistics companies, and we have a chart on that, on the term that you use, dislocation, container ships versus other logistics. And when we look at that chart, you use the word dislocation a lot to describe a chart and to describe the stock that might not be getting the love from Wall Street. And my question is, and I think this is really good for the audience. First off, Jay, how do you define dislocation?
So in terms of dislocation, we're looking at the big macro drivers of the market, right? And we're expecting things to correlate. So, for example, if you see oil prices going up, you should expect most oil companies that are involved in exploration and production to similarly increase in price. What happened here was the container ship market rapidly tightened. Everyone, like even Jim Cramer, was talking about how shipments were up, FedEx was
Right.
crushing it, UPS was crushing it, and we saw all these stocks. And I mentioned most of them already. Matson's another one. They're all at 52-week highs, and some of those other ones, I think you mentioned Triton as well, TRTN. It was at a 5-year high. And then I look over and I say, well, let's look at the shipping stocks, the ones that own the actual shipping vessels. And they're all somewhere between the 52-week lows and like the middle of the range. And it's just this obvious dislocation where folks are looking at these stocks and they're saying that's shipping. And when they hear the word shipping, they think of like oil tankers and dry bulk and iron ore and that sort of thing. And those stocks have had a rough year. I mean, I won't sugarcoat it, but people were, I think, incorrectly correlating those stocks. They're thinking, oh, this is like energy transport, and they didn't understand that those were actually logistics.
It's really an amazing piece of information. You're saying that the market treated a hot container stock the same it would as a depressed oil tanker stock. And that's where the dislocation comes from.
In this case, yes. And I've been involved in the shipping industry for not as long as you, but about a decade now, and it's been so profitable for us as both researchers and also as investors and sometimes traders because these dislocations happen at least once or twice a year. There'll be some sort of weird thing that happens, and this was one that was just so unbelievable, right? And to see CNBC talking about. Like I said, Kramer's talking about UPS and FedEx, and then to look at these trade volumes and then to see all of these container ship lesser stocks. I look into their fleet, I look into their charter profile and when can they renew their vessels, and it's within the next 2 to 3 to 4 months, and they're consistently announcing new charters at record highs, and no one's paying attention to it. And you saw that slide. It's a little bit, I took the liberty to self promote a little bit, but that slide that we just posted up was a public report. It wasn't even like private close to vest. It was private for about 2 or 3 weeks internally at Value Investors Edge. I mean, it's private for first, of course, for our paying research subscribers. But after about 3 weeks, we put out this public article. You can see September 24th, 2020. So almost 2 months ago now. And we put this out and we called out this dislocation. And since that dislocation, we called out these stocks have returned massive numbers. And I think we've only closed about half that gap.
It's fascinating, and I'll tell you why. Because as part of that Value Investors Edge that I belong to, I remember you put a chart out that showed the 52-week highs and lows, within the 5 or 6 containers leasing stocks that we're talking about today, and they were just, they were, to use your word, they just fell asleep, right? I mean, they just fell asleep, and nothing happened with them, and they were just getting lumped in. And I think it's really an important point for my audience to see that the tanker stocks and these stocks that, where oil or energy were involved, they were just getting lumped into this group, and they were just not getting any love. All of a sudden, we go from a rocket ship because of COVID lockdown, and it's almost like a delayed reaction, right? I mean, pretty much that's how it is, correct?
Yeah, absolutely. And remember back in March and April when everybody was trying to be optimistic and upbeat and talking about a V-shaped recovery? And we haven't seen a V-shape in almost any industry except for one, that Harpex chart, right? Look at that 5-year Harpex chart. What a beautiful V. It's actually a check mark, right?
I got to tell you a funny story. I used the chart after your ideas, and I put it on my LinkedIn post, and I said, "Look, we're in a V-shaped recovery." I mean, this is I'm not an economist, but this is so indicative to me of where our audience is going. And now with a lot of the Jeffries report and what Deutsche Bank is saying about restocking, I mean, I just see this flow continuing, and I think it's really kind of cool because it kind of springboards into something that you and I talked about several days ago. Back in March and through August, right? Jim Cramer was saying, and everyone was talking about this word rotation, and we had this huge rotation. Back in the stay-at-home stocks, right? The Zooms and the dash door delivery and the food stuff. So we had, or the Sonos, so whatever the stocks are, where, or even like Target or Home Depot, right? Lowe's, we saw constant, like home improvements was stocks were way up in this rotation moving into the consumerism. But now where things are changing a little bit, right? We're seeing a little bit of a rotation into these value stocks, such as these container stocks we're talking about. How do you determine what a value stock is, and can we have a chart, I think, on where these stocks are and maybe where they can run to, but can you give a little commentary in terms of how these stocks might fit into the new rotation that Wall Street might be looking at?
Yeah, I don't want to get too far out of my lane because I focus, very heavily in maritime shipping. But more broadly, when we look at value stocks, they have been obliterated over the course of 2020. Most value stocks are in things like energy is one example. Energy has not been a good place to be in 2020, right? You have oil prices coming down, you have a lot of climate change talk going on. But that's just one example. There's others. There's industrials, some of the automakers. Stocks like this have been beaten down heavily. Um, we've looked at the valuation gap. Remember earlier we kind of talked about the valuation gap between logistics companies and container box companies. I've looked similarly at the valuation gap between value writ large, which just means your price earnings ratio is lower, right? And growth stocks, which means your price earnings ratio is massive and you're betting on future stuff. So think like Tesla, Amazon, so on. And we've looked at that dislocation and it's massive and it's only started to turn pretty much just after the election and after this vaccine news.
Well, we have a chart. It's called Profit Potential with the Research and Timing. And I'd like to get your commentary on this particular chart because I think this is where, we still potentially, again, I know you don't have a crystal ball, Jay, but I know that, you see the dramatic recoveries of these 5 or 6 container leasing stocks, lessors. By the way, please correct me. What's the best terminology for these? Are they charter companies or lessors?
There's several terms used, but container ship lessor is probably the most accurate.
Okay, well, so let's talk about these guys, and we talk about that maybe the run on the rotation is still going to continue. That might potentially lift these guys higher. You tend to think that there is still a potential for the run. I don't want to put words in your mouth, but what are the key indicators or signs that we might see that might give our audience the indication that there is still room for growth in these stocks?
Yeah, so I mentioned 2 months ago, it was actually about 3 months ago when it was private, and then about 2 months ago when it was public, that we were really talking about this dislocation. And as you can see on the chart here, that just shows the performance. And unsurprisingly, some of the smaller companies are going to give you bigger returns. I mean, it's the same with energy, right? If you buy a smaller cap, higher levered energy stock, you're going to get bigger returns. But you can see the weakest one, I mean, like the worst performing one went up 27% in 2 months, and the best performing one was a triple. In fact, two of them were triples. I believe, roughly speaking, this is broad, right? We don't want to get greedy and stuff like that, but I believe we've closed about half of the performance gap. And when I say half of the performance gap, it's pretty simple here. I'm just looking at how the logistics stocks have performed versus how the box lessors have performed and the container ship lessors have performed. There's three different categories. So logistics companies, talked about them, right? They just handle the actual shipping itself. Then there's container ship lessors, which are the ones who own the ships and lease the ships. Then there's these box lessors that literally just own the metal container. And if we compare the three asset classes, the boxes, the ships, and the logistics, that suggests that we've only closed about half the gap. So that's all I'm saying. I don't want to get too crazy with it, but I'm just telling you we've closed about half the gap.
And I'll give you some of my commentary on that as well too. We talked about somebody like Maersk Line. Maersk just had a great quarter. They had record earnings, but yet their stock still got a little bit slammed by the street because the Maersk puts out that the volumes are down. Well, of course the volumes are down because they're controlling capacity and yet rates are up, so revenues way up, but volumes are down. But they're still very profitable, right? You start to look at somebody like Global Ship Lease, which is a leasing company that leases. At one point, they leased over 50% of their ships to CMA, and I know they're trying to divest a little bit from CMA into other of the vessel operating common carriers. But my question is, I remember in that call, one of the principals, I don't know if it was the CEO or CFO, but he actually made the comment in the call that the Maersks and the CMAs of the world are making money hand over fist. Do you recall that?
Yeah, the liner companies have been basically posting the most profitable year. It's not done yet, right? We're still in Q4, but it looks to be on par with posting the most profitable year, if not all time, at least in the past decade. So they're doing very, very well. But they're starting to hit these container ship roles, right? As the charters come up for renewal, and we've already seen several dozen, almost 100 of these roles so far, which are being done at rates which are double or triple the previous.
Jay, you talk a little bit about what a counterparty is. You talked about that a counterparty is really the issue involved in where how well these container lesser companies are run. Could you just define what a counterparty is? I think that would be important for my audience.
Yeah, so sure, that makes sense. So whenever these companies are leasing their vessels to another logistics company, they got to ensure that it's a solid one, right? That they're not going to default because a lot of times these lease structures can range anywhere from maybe like 6 to 8, 9 months on the low end, all the way up to 10 or 15 years on the high end. So if you sign a deal to lease out a vessel for 10 years with somebody, you got to ensure that's a solid counterparty. So one of the negative things that was hurting these stocks back in March and April was this idea of counterparty risk or counterparty contagion. The idea that the logistics companies were somehow going to have such a terrible year that they would outright default on all their charters, which of course, I mean, that seems laughable now, right? They're having maybe the most profitable year in history. So
Right.
counterparty risk is basically completely off the table.
Jay, it's really interesting. It's really interesting when I look at these stocks. We talked about GSL, and they beat their earnings expectations on both revenue and eventually EPS. But I notice it is a funny industry, right, where they do cater a lot to the Swiss banks or the debt holders, right, of these companies. So it seems like these stocks are a bit odd in a way that they're not necessarily catering to the individual equity investor, where they just put right in your face, 65 cents a share earnings. Why is that? And what type of investment is it really geared towards pleasing the bondholders and the holders of their debt? Why don't they just come out and really say what the earnings are per share in this industry?
Well, I think with GSL's perspective in particular, and I think Danaos Corp as well, DAC, and of course I'm long both these stocks, but they've been playing defense for many, many years. In fact, Danaos Corp, and we've only been long Danaos Corp for a few months here. So in fact, I actually sold the last of my Danaos Corp very recently because they are one of the more levered ones. But they were playing defense big time. I mean, 2 years ago, Danaos Corp was on the verge of bankruptcy. We won't
Wow,
sugarcoat it. A global ship
wow.
lease a little bit more stable than Danaos Corp, but these are companies that are playing defense. So when you play defense, you cozy up with the banks, you tell the banks you're taking care of the bonds, you do the responsible thing, you don't talk about big dividends, you don't talk about more debt. And so they are playing defense. Now, as we emerge through this cycle, we're starting to see those earnings go up and up and up. And once those debts are rationalized and balanced out, which Danaos Corp has done a fantastic job of, I think global ship lease is within months of a major refinancing. Once that refinancing is complete and the bankers are happy, then we start talking about big dividends and equity returns and so on.
And that's where we might get another little possible bump in the stock as well, of course, right?
Exactly. Well, you've seen that yield stocks, high yield stocks are always the most highly valued, right?
Right. Jay, can we talk a little bit about maybe a 30-second outlook on the types of ships? I grew up, talking about the very large container ships, the Panamax and the post-Panamax. We hear the leasing companies talk a lot about the use of the post-Panamax ship, which is a class of ship 10 to 12, 15 years old. Why is the ship so sought after in demand?
Yeah, so these mid-size ships were basically forgotten about. Everybody was pushing for these larger vessels, doing the whole U.S., China, or Europe Asia trade. Everybody forgot that a lot of the emerging growth is Southeast Asia, it's Middle East and Africa, and these ports can only handle those sort of mid-size to upper mid-size vessels. So now we're seeing sort of a renaissance and resurgence in those types of assets, and that's why I think that's a sweet spot to be in.
Wow, that's great. We're really loving the containers, and we see how this pop on 50% really looks potentially really super. I know you cover the whole gamut of shipping. Any other really interesting names out there that might not be containers that my audience might want to take an interesting look at?
Yeah, I know we're kind of running low on time here, and container ships have been great for us, and I think there's still a lot of legs left. But I do know sometimes folks say, well, that's already moved. You've already made a double or a triple on those stocks. What's next? One of the biggest dislocations I see today is a stock called Dorian LPG, stock symbol LPG. They do liquefied petroleum gas, think like propane. Propane trade is booming worldwide. It's not like oil. It's not struggling at all. It's record highs. And this stock is trading just like the oil tankers. It's down in the gutter. It trades for about 9.50, I think, today. I haven't looked at the latest price. It's got $4 or more in cash per share, 40% debt to leverage. Very, very attractive.
Wow, sounds like something that our viewers should really take a look at, and maybe take a look at some more of your commentary, which leads me to not only thank you for being the most incredible guest today, but how do folks get in touch with you? I think we have a little intro on how we can reach out. People can reach out to you.
Yeah, absolutely. So Twitter at Mintzmyer, follow me there. I tweet maybe not a lot, maybe once a day or so. Or go to mintzmyer.com, www.mintzmyer.com. We have 2-week research free trials available. You can see all of our earnings coverage, analytics, and decide for yourself if you like the shipping industry or the energy stuff.
Wow, that's really fantastic. Jay, I can't tell you, you've been a fantastic guest, and welcome so much to the show. And we look forward to having you on again. And we'll say goodbye to everybody on B2B. Watch us on freightwaves.com.
Thank you, Steve.